We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Andrew Gilbert, founder of Sniper Trading. It's a Discord trading community. How are you today, Andrew?
I'm doing great. How are you?
Excellent. Great to have you and talk about some trading here. So why don't we start by having you give us a bit of an overview of what Sniper Trading is, please?
Okay. Well, Sniper Trading it's a group of traders. They pay a fee of €15 a month, and they gain access to trade signals, portfolios, education center, and our main focus is to improve our technical skills, as well as providing you with daily trades so that you can practice what you learn and also make a profit. That covers obviously the monthly fee, which shouldn't be too difficult at €15. That's basically what Sniper Trading is. We have a YouTube, a Twitter, and I do weekly updates on the YouTube channel for Bitcoin. We day trade crypto. Our portfolios are uranium, silver, gold, and then obviously a post-crash portfolio for the stock market. So it's wide-based. It's agriculture, biotech, normal technology, software, electric vehicles, processing material companies, lots of different avenues on our post-crash portfolio. And then our education center for those that want to learn how to trade properly, who want to trade in the 21st century and aren't looking at sort of retail patterns. Then the education center and obviously one-on-one lessons with me are the best way to achieve that.
Mm-hmm. It's a quite active community as well, right?
Yeah. Every day there's at least 15 to 20 people in the members live trading room, all sharing our opinions, our views on what the likely moves are for different coins. And we have over 200 members, paying members, and some are more vocal than others. And, some just wait for my signals that are in the trade signal section. Others, they want to learn, they want to develop their trading skills, they want to improve their technical ability. Mm-hmm. And those are the people that really shine in our Discord.
Excellent. So we're going to walk through some possible scenarios on what you're expecting here. So why don't we start with the gold chart?
Okay, so this is the current state of affairs in gold. And to provide some context to what this sideways action is, we're going to use a Wyckoff accumulation schematic. So for those that don't know what Wyckoff is, it's basically how the bigger player in the market, so you can call them market makers, you can call them the composite man, but it shows you areas of accumulation where the larger players are accumulating before a move up, or they are distributing, which is the opposite. It's just the upside down version of this, where they're distributing, looking to offload into retail that buys it all up, mm-hmm. and then they sink the market in a heavy short, which happened in the Bitcoin chart. If I just pull that up for 2 seconds. So this section right here, where we're at 69K, this is classic Wyckoff distribution, where you have your buying climax, you get this up thrust after distribution, mm-hmm. everyone thinking we're going to the moon, and then we get this breakdown in price. So it happens both ways. You can get a Wyckoff accumulation, or you can get a Wyckoff accumulation or mm-hmm. distribution, sorry. And so for gold, with the current macro conditions, this is definitely an accumulation period where larger players in the market will buy at lower and lower positions. They will also squeeze out other people that have potentially taken sort of longs in this area, and they cash out, and then they buy those at lower prices. So this schematic basically shows that we are awaiting a spring. So here you'll see we've gone through this specific phase. STB is right here, and then we've got our spring phase. And we've got our SDB right here. We've moved sideways, and we're waiting for that drop down to our spring, which also lines up with our harmonic pattern here, which is a Gartley. And if you don't know what harmonic patterns is, again, you can do a little research. You can come join the Discord. But what you're looking for in an ideal scenario is a 618 move to B, a 618 move to C, and then a 786 move to D. And you can see here 618 to B, 618 to C, and we're going down to a 786 level for our spring before we get our move to the upside and leave this level, leave these price levels behind and move further up the chart. And why I think there's going to be a spring is obviously the S&P is at all-time highs. The Fed has decided to change monetary policy, increase its taper and its speed. Oh, the light's gone. So it's going to increase the speed of the taper, increase interest rates, and it's going to offload its asset allocation. That's currently at $1 trillion. And what that's going to do is it's going to make a dive in gold along with the S&P. And then once gold starts to outperform the S&P, that's the perfect time to buy. And then the timing of that is done through the Fed's funds rate. And
hang on
run
a second.
through that with you if you like, or if you have any questions. Yeah.
So, Andrew, before we hit record, you and I were kind of talking about some of the macro factors that also, add up to point you to this direction that we're going to get this spring move, to the downside first. So, what are some of those macro factors that are helping kind of strengthen that case for you?
Okay, well, obviously, monetary policy has changed by the Fed. And so they're going to increase taper and they're increasing the speed. So they're going to finish by March. And they're looking to take assets off their balance sheet and put them back into the market. They're also going to increase interest rates. And all of that together in a very short space of time is going to cause a negative reaction in the stock market. Mm-hmm. And it's going to pull it down maybe 12, 20%, 10 to 20% pull down in the S&P. And that's where you're going to get this spring move where we move down. We hit this level where we've got outer lines of these pitchforks, which this macro pitchfork has predicted the top of this particular move back in July. And it's been pulled from March 99 to 2011 high to the 2015 low. So for those particular reasons, along with all the other technicals, along with the harmonics, along with the Wyckoff accumulation schematic, it all lines up with a move lower before we go higher, before we break out of this range.
So you're saying that gold is likely to get pulled down with a pullback in the stock market as well. That's what you're saying here, right?
Correct. Yeah. The S&P will pull back. That'll bring gold down. This is going to be perfect entry right around the 1589, 1574 level. Mm-hmm. And Chris, from your previous interview, had a level of 1450. And again, that's also a possibility that you get a significant move down towards that level, because currently this move here would be just to my target would be about 13%. Mm-hmm. And, that would mean we would need sort of an S&P drop of about 20% to get that move down. And it just depends on the S&P and how badly it's affected by both the taper, the interest rates, and the assets being removed from the $8 trillion balance sheet of the Fed.
Mm-hmm. There was another scenario that we were running running through before we hit record as well. So could we see
Yes.
more of a sideways consolidation here before another move up? And why do you think that's less likely?
Okay. Well, the second scenario is we get a move sort of up like this. We continue to crawl sideways. You get this break, and then potential swing failure of the all-time high before the S&P comes down. And the reason why it's less likely is, again, from all those macro factors that I discussed, the technicals, both from our harmonics, our pitchforks, our Wyckoff accumulation schematic, but there is obviously a second schematic of accumulation, and that doesn't have a spring. So it is possible, but less likely based on the evidence of the technicals here, and then also the Fed funds rate and its relation to both the S&P and gold, which I can run through with you now, if that helps.
Yeah. Out of those two scenarios, we're looking at the basically the weight of evidence. And when you and I were discussing before about, adding the Fed funds rate in here as well. So what are some of the moves that gold has made in the past that in anticipation of that change of policy or raising interest rates?
Yeah. So basically, when the Fed's funds rate, when they decide to increase those rates, you can start to see a bottoming out in the gold price. And you can also see that the S&P becomes quite weak. So you can see it's making lower highs along here, and gold is beginning to bottom out. Just as we start to see this increase in the Fed's funds rate right down here, you can see that the S&P begins to drop. And this leads to an outperformance in gold. So initially we get a move down and a bottoming out just as the interest rate begins to rise of gold, and then it starts to outperform the S&P 500 just along here after the first sort of increase rate. And so if we look at the percentages, you can get around this time, that this particular time was about 12 to 13% dip in gold before we got that move higher. And then obviously we made a significant move up to 2000. And then obviously I have another example back down here in 2004, where just before increasing interest rates, gold takes a dive. And you can see again that the S&P is looking weak again, where we have these lower highs, and it starts to creep down. And just here where this green marker is, you can see that just before the interest rates begin to increase, gold takes a dive, and we get another 13, 14% dip in gold. And then it starts to outperform just around here. You get another dive by the S&P, and then gold starts to make its move. And then obviously it takes off, over the next couple of years. So it shows that when the Fed and its policy, when they decide to increase interest rates, increase the speed of the taper, and take the assets off their balance sheet, it's going to cause a dip in both. It's going to cause weakness in the S&P, which we haven't seen yet. But it will cause weakness in the S&P right here. And then you're going to get that bottoming out where that spring in the Wyckoff accumulation schematic, which I showed you earlier on. And that's going to get us down towards our $1,500 gold.
And again, if we kind of take some perspective, and getting back down to 1,500 seems pretty dramatic, but if we take that perspective and zoom out a little bit, it's not actually a huge percentage move. It's 10 to 12% from here, right?
Oh, it's light. Yeah, it's a light move. I mean, if you're in crypto, I mean, a 50% drop in a coin isn't like happens every day. So when people are worried about or not believing that something can move 12%, of course it can. And it's a small percentage drop, but it gives you perfect entry for that next leg. And obviously everything needs a catalyst. And for the monetary metals, monetary policy influences what happens to the metals. And so monetary policy is changing, and now you're going to see a dip and then a rise and a breakout of this particular range that we're in.
So Andrew, you've said before that where gold goes, silver will follow. So what does the silver chart look like as well?
Yeah, no problem. Yeah, so silver looks very similar. It's actually doing the exact same as gold in terms of the Wyckoff schematic. And we're also looking for that spring, which it could be around 20, depends on how strong the buyers are when it comes down towards that 20 level, because that'll be a psychological level. Generally, it's those round numbers, 20, 25, 30. So around that 20 level will be quite psychological, and it may hold there as the spring. We have a lot of confluence in this area where we have a daily level, daily naked point of control, two weekly naked points of control, our 618 fib ratios, so our 618 and our 66. And it all sort of lines up for that potential bounce. It would get quite a strong move if it moved into this area. And that would be 17%. So that's easy. You know, I think silver could easily make it down there. If the S&P drops 20%, I think silver's it'll easily make it down there, because it actually overshoots the S&P in terms of percentage drop. So the S&P might drop 10%, it might drop 13%. So from the percentages, it looks quite easy to get into this $19, $18 silver. But it wouldn't be unwise to start accumulating in and around the 20 mark.
And again, I want to go through this stuff with you just to see some different scenarios of what could happen to the metals before we really see an appreciation and think about what can happen in anticipation of the rate hikes that we're supposedly going to see. It'll be interesting to see how long they last for as well.
Yeah, I mean they've said they're going to increase them. So if they backpedal before they even increase them, I don't know what the market's going to do, but I imagine they will at least do one or maybe two, and we'll get to see what the S&P is made of.
So Andrew, why don't we move to the S&P chart and show us what you're looking at there for some levels.
Well, okay, so it's difficult to chart something that moves only in one direction. So it's just been parabolic move to the upside. So in terms of exact levels as to where it'll reverse is difficult, but the economic growth is slowing. So returns, both company earnings are going to be affected by the slower growth. And so I don't expect us to be like taking off up to 6,000, 6,500. I don't expect that before we get our move down. And so I expect us to range potentially in the zone where we start to maybe see some weakness, potentially reach that psychological level of 5,000 or the one-to-one extension of 4,918. But in terms of accurate projections, very difficult with the S&P 500.
So how does the dollar play in here as well, Andrew? When we see weakness in the dollar, that's typically correlated with strength in gold. But how do you see the dollar chart playing out from here?
Well, the dollar is quite it's quite interesting in terms of it generally does the opposite of gold. Mm-hmm. So if we have a look here, okay. So if we look at both what the dollar does and gold, it's generally a negative correlation. So mm-hmm. you'll generally get this move down as gold appreciates. So if my predictions come true, where we see a dip in both gold and silver, then we should see a significant dip down towards the 89s, the 90s, down to the 70s, most likely, depending on the severity of the gold price move and obviously Fed's policies.
So there,
in terms of targets, like I don't generally look at the dollar. Mm-hmm. It's for me, it's a non-issue. It's not going to provide a better entry for gold and silver. Mm-hmm. So for me, I don't really mind what the dollar does. From a short-term perspective, this 97 to 98 level, mm-hmm. that looks like a reasonable target for a potential reversal. But depends on what happens over the next few months.
Mm-hmm. So as part of all of these, all of these scenarios playing out, Andrew, where once the Fed raises rates, the S&P just kind of causes this cascade of, let's say, margin calls, or whatever you want to call it, through all of these other markets. How are you seeing the Bitcoin chart play out as well?
Yeah, well, with Bitcoin, it's quite interesting because everyone thinks that we're going to that this is our last accumulation zone before a move to the upside. Mm-hmm. But because of the change in policy, they're missing sort of a key ingredient. So you can see that we took off and then we dropped a significant amount and accumulation along here with the Wyckoff accumulation, right? Mm-hmm. And monetary policy hadn't changed yet. The Fed was still printing money. It was all transitory inflation, whatever you want to call it, that's what they called it. And so there was no change in monetary policy, so it allowed Bitcoin to move again to the upside. And that's the difference with this particular move down, is we're likely going to see a significant dip down towards the 20s. Mm-hmm. I've said 20,000 by June. And I would say the majority of YouTube crypto analysts they're still believing it. They're still providing hopium, and it's rare that you're going to find someone that believes that we're going lower. Mm-hmm. Because everyone wants to believe that the party never ends. And when we lose this key support right here, which is the last support before the all-time high peak. So if we just do a quick drawing here. So we might get another move up, right, towards the 50s, maybe even 60s. But we should see, once the S&P drops, this thing is going to drop like a stone. Because when the Fed minutes came out last week, the S&P dropped 2%. And Bitcoin dropped 10%. Mm-hmm. So that shows you the volatility that's within Bitcoin. And mm-hmm. so I expect, it's not that far away. Even if we got to 60K, it's only a 50% drop to get down into the 20K zone. Mm-hmm. And so this last key support is the last down move before the up move, and we're trying to hold it as support. So YouTubers currently will be continuing their storyline or narrative that this is a sideways consolidation before we break out up into the 100K zone. And it's unfortunately, it's not going to happen this year because of the Fed. And when we lose the key level here, that's when the YouTubers may change their tune and say that we're officially in a bear market, or they may still hold on to some indicators or technicals that give them some hope, because that's what they like to sell.
Mm-hmm. So, Andrew, why do you think that the Fed minutes being released caused such a violent reaction in Bitcoin? There's a lot of things that seem to be going against it right now. But why do you think the Fed minutes had such a large impact?
Well, it's because it's a technology. It acts exactly like a tech stock. So if the Fed is going to increase its taper, increase interest rates, and remove assets from its balance sheet, then that's going to constrict growth. And because it's a growth and a momentum stock, or a coin, whatever you want to call it, that is the main reason for this likely scenario.
Mm-hmm. Excellent, Andrew. Well, that's it shows you've walked us through a couple different scenarios on where these assets are headed and some reasons as to why. Is there anything else you'd like to add before we wrap up here?
Just to check out Sniper Trading. I'm sure I'll provide you with the Discord link, and the Palace Days Gold Radio listeners, if you're interested, we'll be doing 50% off your monthly subscription using the word gold. Mm-hmm. And yeah, I'd love you to come and check us out. You'll definitely improve your trading skills and your technical analysis. And of course, you'll have access to portfolios and the education. So we would be thrilled to see a few Palace Days Gold Radio people join us.
Excellent, Andrew. Thanks so much for your time today. And just remind us of the Twitter handle that you guys have and where to find you.
Yeah. So at Sniper Trading 1 is our Twitter. Mm-hmm. And our YouTube is Sniper Trading. And if you type in Sniper Trading Bitcoin, it's got a wolf face on it, and that's us. Because there are other sniper trading platforms.
Mm-hmm. Perfect, Andrew. Thanks so much for your time today.
No problem. Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.